What this does not mean is how you have personally performed on this fund in the last 10 years. What's up guys? So if you're tuning into the channel, you'll know that I'm kind of going through my story of how I'm getting my finances in line. Part of that story was me leaving the big banks and going to an online broker for my investments. Now, in my last video, which I'll leave a link at the top here, I talked about why I left the bank and my dissatisfaction with the financial planner. Now, I did mention that I was going to go over one of the summary sheets. These are one of the sheets that they use to describe portfolios. I thought this might help you guys, so I'm gonna put this sheet up on the screen. We're gonna talk about that in the first part of this video, but later I'm gonna go over the proposal that my financial planner put in front of me, and I'll talk about why I didn't go for that. All right, so let's get started. At the very top of the sheet, if you follow along on the screen, you have the portfolio value. That portfolio value right now, it says $41,879. That's the actual value in the account. When your financial planner tries to create the sheet for you, they'll use the number that's close, if not exact, to the amount of money that you have. I'll get back to this later. Next to that, you have a very important number called your MER. That's a percentage. So that's 2.56% is what I was paying on this particular portfolio. That is very high. You should definitely look into any portfolios you have that have MERs that are higher than 1.5 or 2. The number next to that is the annual fund expense. That number there is your MER times the portfolio value. That's how much you pay every year in fees based on this MER. So I was paying $1,100 just for this account to be managed by the portfolio at the bank. Portfolio yield, we don't have to worry too much about that. This is only coming into play if you have dividends. This part where it says benchmark, that's just to the right of that. You'll see in some other portfolios that this benchmark will just say something like custom, and I'll get into that later in this video as well. Going back to the asset allocation section, that's just showing you a pie chart that shows you all the things in the portfolio, what type of assets they are, whether they're cash, equity, US equity, international equity, equity being stocks. Fixed income is things like bonds, and there's some others. So in this pie chart, most of the assets are in equity. That makes sense because this is an aggressive growth type of portfolio, and that typically means that you're invested in stocks. If you go to the right where it says stock analysis, this just shows you the types of industries that you're invested in. So the biggest portion of my portfolio here is in financial services, followed by technology, followed by industrials, and the percentages of each are just on the right there, and it has a little bar graph to show you as well. So it just shows you the makeup of the type of businesses that this portfolio has. Moving down to bond analysis, right under the pie chart there, this gives you the credit quality of the businesses that are in the portfolio. So AAA is the highest credit rating that a bank will give a company. So 76% of all the companies that are owned in this portfolio have a credit rating of AAA. Then it goes down to AA, single A, triple B, double B, single B, and so on and so forth. NR is not applicable or not ranked, I guess, and I have a portion of these stocks that are in there. I believe that just means that these aren't businesses, those would be bonds or fixed income or cash. So that's why there's 23% in there. To the right, it does a similar breakdown of all the fixed income pieces. So you know from the pie chart, I have a small sliver of fixed income. Of that sliver, most of that is cash and equivalents, as you can see, and a little bit of it is tied to the government as well. If you go to the right of that section in world regions, it shows that most of the companies in this portfolio are from the United States and Canada. There's a little bit of Europe and Asia and emerging countries in there as well. And it kind of gives you a map just to give you a visual of that as well. Now, this could be important for you if you would like to diversify your portfolio or maybe invest in countries that are doing better economically than maybe your home country. You can get a visual there of what parts of the world this portfolio is invested in as well. Now I'm gonna get to the performance curve at the end, so I'm just gonna skip that one for now. The table to the right of it that says annualized returns, that's just really summarizing the performance curve in averages over 1 month, 3 months, 6 months, a year, 3 years, 5 years, and so on. So it compares the average per year return of this portfolio next to the benchmark. So let's go down to the bottom where it says holdings. And this section just describes if you have a blend of different portfolios, it'll list all the portfolios down here and what percent you hold in each portfolio. It'll just list all the portfolios and bank products that you bought here at the bottom and give you kind of an idea of how much you own of each. In this particular sheet, all the money in this account is in this RBC Select Choices Aggressive Growth Portfolio A. So I don't have anything else listed here, but sometimes you'll see that. Now, my favorite part, and I think the most trickiest part, is this performance curve. Now you look at this performance curve and it compares you against a benchmark. So that's the first thing, is we don't know what the benchmark is. And I asked my financial planner what that is. Now, sometimes you'll see like they use a Morningstar Global Aggressive Growth Fund. What that fund is something that has a similar breakdown to the portfolio that you have. If you see that benchmark in the top right corner say custom, then that means the financial planner has sort of broken down and created a blend of funds that is his own benchmark or her own benchmark for this. That's where it gets really tricky, because you think that you're comparing your numbers against the market, like maybe the S&P 500, but you're not. You're comparing it against a similar portfolio. So just think about that. You're comparing it against something that has the same blend of companies that you've already selected in this current portfolio. So if you look at this graph, you'll see that it gives you data for 10 years. On the bottom, it gives you the total percent return, what the benchmarks returned, and the difference between the portfolio and the benchmark is on the third row of numbers. The benchmark is in blue, and then the red is the portfolio. And you can see that early in 2009, 10, and 11, it performed better than the benchmark, but now as it progressed and in the last 3-4 years, it's actually consistently underperformed its own benchmark. So what that means now, remember, if you watch my previous video, you're paying that $1,100 a year for this portfolio, whether it makes money or not. If this portfolio gets you, say, 10%, I still pay 2.5% back to the bank in fees. If the portfolio underperforms and makes -5% that year, I still have to pay another 2.5% in fees anyway. So you pay fees despite what the portfolio does. Now, here's another interesting number. See where it says final market value, that 41,879? We've seen that before. That's the number that was at the very top left of this sheet. That's the number that the financial planner will use and just plug into this chart. What this does not mean is how you have personally performed on this fund in the last 10 years. I actually didn't hold this fund, this portfolio, for 10 years. The bank switched me in and out of different portfolios, and so when they give you this data, they're actually just showing you what the portfolio's done, not necessarily what your money has done in the last 10 years. That's very important, and it's misleading the way that they use the actual money that you have in the account as the final market value. Above that, it'll just say the initial market value. This just means 10 years ago, you would have had to invest that amount of money in order to have the amount of money that you have now in this fund. In order for you to find out how you actually did, you would probably have to go out and pull a statement from 10 years ago and see what you actually started as an investment. The other thing to keep in mind is the bank will also try to sell you on putting in regular contributions into your investments every month. That's actually a really good idea, but it's very difficult to calculate how well you did over 10 years when you've actually been putting money in every month. That is not reflected in this chart. The only thing that is similar to your bank account is that final market value. So I just want to make sure everybody's clear on that. All these numbers on the bottom are calculated after the MER has been taken out. That's what my financial planner has assured me. So in 2017, that 13.44% it shows as the benchmark. That's after the 2.56% has been taken off as part of the MER. So that about does it for this sheet. We'll go on to part 2 in a second. Hey, if you guys are finding this information useful, please hit that subscribe button. That would really help me out as I'm trying to grow this channel. All right, part 2 of this, I'm going to talk very quickly about the portfolio that my financial planner proposed to me after I realized how much I was paying in fees and kind of called him out on it. So I'm going to put that up on the screen now. Now we'll flip to this similar page and look at the difference. Now keep in mind the portfolio value is different because this is for a different account, but look at the MER. It's 1.5% now. So he's improved there. Even though the portfolio value is greater, my annual fund expenses are a lot lower than the previous one. This one has some dividends in there, so there's a portfolio yield, And look at that, there's that custom benchmark. So all else being equal here, the investments are quite similar. So I'm just gonna jump down to the very bottom where it says holdings. You'll see here, he's listed a bunch of different bank products. Notice how they're all from RBC because that's all a bank can really give you when you are using a financial planner. So this is just a blend of different products from the bank. He does this mostly to bring my management expense ratio down. Now let's go up to the performance curve. Final market value, same number as we have at the top. Initial market value, not necessarily what I put in this account. This is just telling me that I only had to put in 25K to have 64K now 10 years later. And look at that. See how that red line consistently outperforms the benchmark? Wow, isn't that tempting? Pretty good, hey? This is where it gets really interesting too, because it's very easy for a portfolio manager to put this together by just back calculating a bunch of different portfolios that have performed really well in the last 10 years. And just because they've performed well in the last 10 doesn't mean that they'll consistently beat the benchmark or beat the market every year. When you have historical data, it's easy to stack it in a way that makes it very tempting. So a little bit about the benchmark. If it says custom, what the financial planner is supposed to do is look at the asset allocation, look at that pie chart, and then go and get stocks or portfolios that are similar to that type of blend. So he'll go out and he will create the benchmark and he'll give it a couple percent of cash. He'll take Canadian equity companies like the TSX and make that 22.66%. He'll take the US equity section, maybe he'll make that the S&P 500 and just get 31% of that. He'll take international equity, do the same thing, and then fixed income, he'll do the same thing. And he'll just create a similar asset allocation and then back test it to create this blue graph with the red line that shows it on top. So here, he can easily go back, look at all these 6 RBC products he's picked and find the ones that perform the best. And when he does that, it shows clearly that this is an all-star type of portfolio. But that's really easy to do when you have all the historical data. That doesn't necessarily mean that this is going to be the best portfolio for me. So guys, that's about it. As I said in the last video, I didn't end up taking this proposal. I decided to move my money out of the bank, put it in the market, and just put it in the S&P 500 in a ETF that's called VSP.TO. It's a Canadian hedged S&P 500 ETF. With that, I feel I can just let my money sit, I can make regular contributions, and the market will just improve over time, and I do have a few decades of runway, which is a lot of time for the market to grow. Well guys, that's the video. If you liked it, please consider hitting that like button. Next time, I'm gonna be talking about productivity tips and what I do to be more productive in my week. So until next time, spread the wealth, and we'll see you in the next one. Bye.